Today we are discussing Gartner Inc., ticker IT. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. They're operating in the IT services industry. They have a market cap of $25.7 billion, enterprise value of $27.4 billion. So you see about $2 billion in net debt on this business. Pretty low amount, less than 10% of the overall enterprise value. They are a research and advisory company in the US, Canada, Europe, Middle East, Africa, and internationally. 3 segments: research, conferences, consulting. Research delivers its research through subscription services, on-demand access to published research content, data and benchmarks, direct access to network of research experts. Kind of interesting. Conferences offers business professionals. Basically, they host conferences, it looks like. Consulting, they have market research, customer analysis, on-the-ground support services. Kind of an interesting business. So they have actionable solutions for IT-related priorities, cost optimization, digital transformation, IT sourcing. Okay. Doesn't tell me a lot about what they're actually doing besides in this conferences business. But selling data, selling research could be certainly a good business, could be scalable. Return on invested capital should tell us a decent amount. And you kind of see that they're bouncing all over the place. They had like a long-term trend of improving results up until 2012, where they had 37% return on invested capital. And then it dropped back down again by 2017 to 0. But now they're back above 20% in the last 2 years. There's a significant amount of volatility here, not necessarily so much on a year-to-year basis, but just across the 2 decades. You went from 6% down to negative, up to 37, down to 0, up to 23 again. That's very unpredictable on a year-by-year basis, even though the overall results are very, very good. You have 19 years of profitability over the course of 20, which would certainly meet my metric for being a high-quality business. And you have quite a few years of very, very good returns on invested capital. I'm looking for numbers that are 10% plus, and we can see quite a few years above that number. So basically, your only years below that number are 2003 through 2005, and then 2017 to 2020. Besides that, last 2 years are both above 20%, and you spend a lot of the time in this 20% plus range. You were above 10% in 2006, 2007, and 2009, but otherwise, you're above 20% for most of the other time. And 20% returns on invested capital are very good. Those would be world-class. But the biggest weakness I see here is this big drop-off in 2016, 2017, which could be explained by something like an acquisition, which we're going to look at deeper when we get to the financial statements to understand, did they make a big acquisition in this period? That could drop the return on invested capital if it didn't show immediate returns to the bottom line. But if it starts to pay off, and that's what's led us to these higher numbers, then that's a really good sign, because it just means this is a short-term problem. It's not a long-term problem. And maybe that was a one-time investment thing that has led to ultimately getting very strong returns. So overall, high quality business thoughts so far. Your gross profits continue to meet that mark. 62% is above the 50% margin mark that I really like to see on a gross profit basis, and they're earning respectable operating margins of 14%. Now, return on median. These 10-year median returns are very, very important. I want the return on invested capital again above 10%. We're hitting 22%. Return on equity of 40% is above my metric of 15%. Either way, these are world-class numbers, definitely following into the high-quality business category. Likewise, once I know I have a high-quality business like I do here, what am I looking for? I'm looking for high growth. And high growth to me is anything where your revenue and earnings are growing above 10%. And you certainly see that here. Revenue growth of 13%. EPS growth of 19%. These are very attractive numbers and make me very excited as a potential shareholder, because I can quickly see how I can earn good returns on my investment. As a shareholder, your returns are driven by the growth rate of the company and the returns on invested capital. So if my returns on invested capital and return on equity exceed my target rate of return, which let's say my target rate of return is 10 to 12% or more, and all of these numbers exceed that, I'm growing faster than 12%, I'm growing my earnings much faster than 12%, and all of my returns on capital, whether equity or total invested capital, are well above 12%. When you see those numbers like that, everything's lining up for you to get the returns that you want as a shareholder. When the numbers are below that, it requires a little bit more finesse. Now you have to start talking about valuation changes. How do you work in growing multiples? Stuff like that to justify buying it. You really need to do a granular check on dividends. Otherwise here, we have the growth I want. We have the returns I want. Now it all comes down to valuation. And this is where we get the first hiccup. We see the PE ratio of 31.8. The first thing I'm going to have to do as I dive into these earnings numbers then is understand, is the current earnings number relatively low compared to its history? history, or is it a peak? If it's a peak, then certainly this company is at a high valuation. I've never paid a PE of 30 or more, and I don't plan to start any soon. So I would say, although this is tracking to be on a watch list because of my growth rates, because of my returns on invested capital, something like a PE of 31 is quite high. So I'd want to understand, are these earnings maybe a temporary drop, so it's not actually that expensive? Or if it is that expensive, where am I going to look to buy? I really like PEs of 15 or less. That gives you a very strong, reliable margin of safety for hitting my rates of return, especially with these margins and especially with these growth rates. So let's go down to our quick 10-year look at this income statement. We see you've grown revenue from 1.7 billion to 5.4 billion. You basically tripled your revenue over the course of a decade, which is very impressive. And when you triple your revenue, you set up for very strong returns on the earnings line. And we do see that here. You've gone from $1.93 per share to basically $10 per share. So you 5x your earnings over the course of a decade, which is very impressive. Anytime you can 5x your earnings in a decade, that's going to lead to very attractive returns. 5x earnings should drive all else equal on your multiples is going to be a 5x in your return as a shareholder. So you're starting to look, man, wouldn't 19% returns as a shareholder be very attractive? And it certainly would. The important thing to think here is, too, we can quickly see that the EPS number, you take that $9, $10 a share, and you compare it to this $325 in terms of your closing price, and we can see this PE ratio is relatively accurate compared to our recent earnings history. Earning $10 a share, this would suggest it's a 32 PE. Quick, dirty math, very easy, and you can clearly see that, no, this isn't an overstated number. In fact, these numbers could be higher than their true earnings power. You'd have to do a deeper dive. But either way, we can't simply write this off as saying, okay, that's actually cheaper than it looks. No, this company does look expensive, but it's because other people in the market have probably figured out what we have here, that they're earning good returns on capital and they have a nice growth rate history. You do see this big drop again, 2016 to 2017, even though they had a 35% revenue growth. I'm going to guess that's driven again by acquisitions because this is a very big revenue growth. It's their largest growth year over year, and it was coincided with a big change in their operating margin, operating profits, despite everything else going well. So they probably had some one-time expenses associated with that, and I think that's probably the driver you would have had there. Now, to figure that out, we're going to go into the income statement, balance sheet, and cash flow statement next. But if you're enjoying this video, hit that like button, and I'm going to convince you to subscribe by the end of this video with all the extra value we can get by looking at these statements. So let's go to the income statement now, and let's dive on in here. You do see immediately, you can go to again 2016, 2017 are the key areas for us to study because that big jump, and you can see their cost of goods sold jumped significantly and their SG&A went up significantly. A 50% rise in SG&A would be very abnormal on a simple organic basis. That's not just hiring new employees. That would be you've acquired employees. You've gained a big jump in your business, and it's because of something you've done there. So this again would suggest more than anything else that I had an acquisition there, which we're going to confirm later on again, but we're continuing to see that as a storyline. One thing to be aware of on the downside of that is if you're making a big acquisition and that causes a big bunch in your revenue growth, then not all of this growth is organic. Some of the growth is driven by the fact that you made an acquisition, and it's not just all internally generated. Now, they might have bought it all with cash, which would be a big positive in that regard, but just something to be aware of. One thing I like seeing here, though, is your shares diluted have declined from 95 million to 81 million over time. That's a very good sign as well. So you've bought back, somewhere in the 15% range of your total shares outstanding over the course of a decade. And it's going to give you about an extra 1% return per year because of those buybacks. Likewise, we see another clue of an acquisition when you see this jump in shares outstanding in that 1 year transition, 2016 to 2017. That's showing you that everywhere else you're basically decreasing shares outstanding. Right here you see a big 1 year jump. That could be because they issued shares to make the transaction go through. You could see positive operating profit every year, positive net income every year. Very good sign. So balance sheet. And here's our final clue of the acquisition. You can see the big jump in goodwill and intangible assets, and that led their total assets to go from $2.3 billion to $7.2 billion in that single year because you added $2.2 billion in goodwill, another $1.2 billion in intangible assets. So that's about $3.4 billion in additional assets that have nothing to do with their PP&E. You can see on a PP&E basis, they're actually not using much capital at all. On their tangible assets, you went up $100 million in tangible assets to $222 million in PP&E. You're only at $700 million in PP&E at the end of the decade, which is very impressive because when you compare that to your net income number, you're earning more than 100% return on your PP&E based upon that balance sheet. So you're earning very strong returns on invested capital. In fact, the only reason the numbers show 20% here instead of 100% is because of all these intangible assets. Now, that's a GAAP accounting thing. You have to have that because you made the acquisition. It is embedded in your price, but it is something to be aware of that this really isn't using a lot of assets. What are your other assets other than this? You have cash, you have accounts receivable, and a few other assets. For the most part, this business is running on this $1 billion. They're earning about 100% on tangible assets, which is very, very impressive. You can see they took on debt to make this acquisition, and their debt has tracked pretty well with that asset base. I mean, $664 million there. You added a similar amount of debt as you did goodwill. Nothing wrong from that side to me. And, you're certainly not growing your debt that much faster than you are your overall business and your profitability. Everything seems to be reasonable from that end as well. Okay. So you do have some capital leases, but they're not a huge amount. One thing I don't like that I see here is, of course, pension liabilities. Pension liabilities are a bad sign. You have to do a really deep dive before buying a stock with pension liabilities because a lot of times those can be calculated in a way that understates their true cost. So although that says the liability here is $124 million, it could be a lot more than that. Depending upon the assumptions that they made, and you might need to tweak that yourself, but you need to go into the 10K document for that. Now let's go to the cash flow statement. You see some change here in deferred tax. Of course, you have the 2017 Tax Cuts and Jobs Act that would have impacted them there. You see your $2.6 billion acquisition. Really only one big acquisition over the course of this decade. They did have some other smaller ones, but for the most part, one big acquisition influences them. And the acquisition didn't require a lot of share issuance, it looks like. They're actually buying back shares each and every year, and you can see that they're dumping all of their excess cash is going into stock buybacks. There's no dividends being paid. You do have some debt being paid down, but basically they're funding all of their money into stock buybacks, which is a really good sign for you as a shareholder because of how that impacts you. If you think about saying, okay, this is a high quality business. Well, if you want a high quality business, then you would also want a company that thinks of itself as a high quality business and that its shares should be valuable. So when they buy their own shares, they're buying something valuable that's valuable to them, which means it's valuable to you. And so share buybacks on businesses like this are very attractive. It's hard to acquire other businesses that meet these sort of metrics. So that's why they only have that one acquisition over the course of a decade, but they can always make an acquisition of themselves when they buy back their shares. So I like how the capital allocation is working here. Overall, I'd say this is a very attractive company. They're earning near 100% returns on their tangible assets, which is the mark of a very good company. The mark of some companies, though, that have those types of returns is they can't grow. Yet we see this company is clearly growing in the double-digit range, which starts to make it very, very attractive. The only downside is the current price. The current price is relatively high. PE of 31, 32 is more than I would be willing to pay. I would much rather have something that's closer to the average price of an S&P 500 stock. Again, those PZs of 15, you're talking about prices in the $15 to $16, $150, $160 range based upon these current financials. And so that's where this company starts to get very exciting. But again, that means it's a watch list stock. It's not an immediately buy for me because it does look like it's slightly overvalued. Now, can you justify this valuation? You could possibly. I mean, what happens if you buy this company at a 32 PE and it goes to a 16 PE over the course of a decade? Well, it's going to add about a 7% drag per year on your overall return, which means that it's going to drop your growth rate by 7% for you as a shareholder. However, if you happen to replicate the last decade and you grow at 19% a year, but you lose 7%, due to the multiple compression, you still might end up with a market beating return of 12%. Now, again, that assumes that all these numbers can replicate, which I would not expect because it did include an acquisition there. Your true growth rate is probably lower than that, but I do think you're probably growing faster than double digits still. And so that means you're set up for some really attractive returns if you can pull it off. Overall, Gartner Inc., that's just going to be a watch list stock for me. I really like companies with these high returns on invested capital. Just a little bit of a high price for me right now. If you learned something from this video, hit that like button and please consider becoming a subscriber. I'm going through every company in S&P 500 and my favorite ones are in this watch list playlist up above. Check those videos out. I've already covered 40 to 50 stocks that I think are really interesting and attractive and that you'll probably enjoy if you enjoyed this video. So if you want to learn how to do this software yourself, my link to it is in quickfs.net. It is the first link in the description below. That is my affiliate link. So please consider using my link to sign up. You can get a free or paid account on there so you can access all this great information on the companies that I cover and other companies around the country. So thanks for listening. And until next time, stop paying fees, start building wealth.